Okay, good morning everybody. Thank you very much for joining us. My name is Jenny, I'm the Managing Director here at Dragon Argent, and this morning I'm joined by Sanjay, who is our Strategic Tax Advisor. So just before I pass over to Sanjay, just a little bit about us and really the point of what we're doing this morning. We at Dragon Argent, our goal is to solve problems for entrepreneurs. We've been around for about 20 years or so, and we have a team of accountants, tax advisors, lawyers, and business advisors here that support founders to free founders up to focus on the bits of running their business that they enjoy and do best. So one of the things that really matters to us is just adding more value and bringing useful topics to new audiences and also to our existing clients. We've got a great team here, so we do lots of these webinars and talk about loads of different things. So tax is a fairly big topic and Sanjay could probably, I suspect, talk about it for days. So we've got, Sanjay's pulled out a couple of key things that we'll talk about this morning. What we're going to do is pause after every one of them and ask for any questions, and then we'll carry on. It could just be because it is a fairly technical topic, we thought that might be a better way of doing it. So a few logistical things. The webinar is recorded, we'll share that with you afterwards. And the chat button, the chat bit there is obviously open, so please just anytime a question jumps up, pop it in there. So yes, without any further ado, I shall pass you on to Sanjay, who's just going to introduce him a bit before we start doing some Q&A.
Yeah, so my name is Sanjay. I started my career at PwC in 2014. So I joined the tax team there, but specifically the Global Employment Taxes team, which is basically where we work for companies who are sending people abroad or bringing people into the UK. So I've got a lot of individual personal tax experience of people moving around worldwide, but also working with corporate accounts and companies and how that's all structured and how they do it, how it works from a taxation standpoint from an individual basis, also from a company basis. So I got a lot of experience with that. I did that for about 6.5 years and then moved into more of a direct private client role. So obviously I was kind of very niche area of tax, it was very specific, so I wanted to broaden my horizons. So at that point I went to more private client and it was working directly with individuals doing their tax returns and giving them tax advice. And then from there I moved on to more of a corporate and individual basis, but more just purely advisory. So obviously there's people who just need to file their tax returns and that's kind of the easy side of tax. But people who actually want to do tax planning and sort of move their tax around to be a lot more tax efficient, you need to be a bit more holistic. So being specialised didn't really work. If I know somebody's individual personal tax rates, it doesn't help if they have a business and they want to be more tax efficient with everything together. Then you add in inheritance tax planning, you kind of need to know a lot more about tax in general to give that sort of advice. So I've been doing that for about 3 to 4 years now, sort of helping small to medium sized business owners sort of plan their tax affairs, both from a corporation tax standpoint of view, from an individual tax point of view, and an inheritance tax point of view. So giving advice on everything altogether, including stamp duty.
Yes, so much Sanjay, so much. And that's what Sanjay does for us, for our clients here, because our clients are founders and have, exactly like you say, have got their life and their business, and actually having your expertise to look holistically gets them the better outcome, really. So I'm just going to jump straight. The topics that Sanjay is going to talk about today, and this will be, we can do more of these webinars. This is an enormous topic area. So the ones that we're going to talk about today are group structures. So what are they and what's the benefits of considering one? Expenses. How can you use them to your advantage? Pensions, profit extraction, and exit planning. So we're going to start with the group structuring. So can you just tell us, to somebody who doesn't really know, I mean, we at Dragon Argent do have a group structure, so that is something I have learned about of late. So can you explain what it is, why I should do it, and when should I think about doing it?
Yeah, of course. So obviously, when most people start a company, they incorporate a company, they own the company, and that's just generally how it works. It's a nice, easy, and simple process, and that's what 90% or 99% of people do. They just start a company, they own all the shares directly, and that's effectively like the most common way to do things. But it isn't always the most tax efficient way to do things moving forward. So the idea of a group structure is there's normally a holding company right at the top, and there's multiple subsidiaries below it. So you don't have to set these all up instantly. You can set these up over time. But the idea is the holding company, so you own the holding company, and then the holding company owns the shares in your trading subsidiary, which normally, if you didn't do it that way, you would own the shares directly in your subsidiary. So effectively, this would allow you to set up multiple different companies within the same group structure, and it kind of lets you divest and try out new different things while giving you tax benefits of utilising this sort of group structure. So a lot of people, a lot of entrepreneurs, they don't have just one idea, right? They have multiple different ideas. And it doesn't really make sense to do them all within inside one company. So they generally set up 3, 4, 5 different ideas and different companies to do these sort of ideas. And then they're always seen as standalone and separate, but there can be benefits of having them all inside one group structure. So the holding company owns each subsidiary rather than you owning each 5 subsidiaries separately.
Oh, okay. So at what point? At what point should you start thinking about doing that? Is that something which, I mean, I guess you don't know, I suppose when you have your first idea, that is the thing that consumes you. And you might not have the capacity, or you might just want that to be the one thing which is successful. So thinking about that not working or thinking about the future and other things might feel a bit odd, but is it just a fail? Is there any downside of doing it?
So technically speaking, there's a slightly more administration cost, right? So instead of setting up one company, you're setting up 2. And technically speaking, there's accountancy fees for 2 companies. But the holding company doesn't really do a lot. You just hold shares and then money goes into it sometimes. But in reality, there really isn't a huge amount of extra work by having the holding company set up, and it kind of future-proofs you for like future expansions and future growth. You can technically set up a group structure after you've already set up a company, but there's a lot more admin and a lot more legal costs in moving things around. So by doing it this way, you are sort of saving cost in the future by setting up in not the correct way, but setting up in a future-proof way, I'd say.
Okay, yeah, that makes sense. So does anybody have any questions on anything to do with group structures? If they don't, then we will just carry on to the next one.
There's a few more things I want to talk about group structures.
Oh, sorry. Carry on.
So like, there's certain benefits of having a group structure, right? So obviously, the idea was having everything within one entity. Well, not one entity, but effectively one group structure. The idea, there's certain reliefs that you come with this sort of stuff. So assets can move freely from one company to another. So normally, if you want to move, say, a property or like an asset you own in a company and you move from one to the other, you have to pay tax to move it from one to the other. Within a group structure, there's a no gain, no loss sort of idea of things, where things can move completely freely. There's no stamp duty cost and there's no corporation tax cost of moving things around. So that's a really good benefit. So if you want to restructure your companies, or certain assets are held within one and you want to separate them out, a lot of people do it for legal reasons even. So some people might own a property and they might lease the property from a different company. So if one gets sued, it doesn't take away the asset value. If you have a group structure set up, you can move things freely and you can basically set this up very easily. And then there's also inheritance tax benefits. So if you had that idea of, if you had these 2 standalone companies and one owned a property and the other one leased the property from that company, if they were standalone, that property company wouldn't have inheritance tax relief with it, because it's seen as an investment company, not a trading company. But if you have it in a group structure, it's all seen as a collective and you get this inheritance tax relief with it. And then, so obviously, if you have a group structure, you can separate things out, but that also means you can sell part of your business quite easily. So before, you would have to sell an asset or you'd have to sell a part of the business and it's all collective. Here, you can separate it out and then sell it on quite easily as a limited company itself. That can be quite beneficial. And then, sort of when you're looking to do this, obviously at the start it's probably the best idea, but also for exit planning it can be really beneficial. So you really want to be looking at this sort of stuff 4 to 5 years, maybe 6 years before you're looking to sell, because with this sort of group loss relief where you can transfer assets, there's a degrouping charge at the end of it too. So it basically means that if assets are moved from one company to another within 6 years of sale, they would then be subject to tax. So really you want to be looking at sort of 5 to 6 years. That's really when you're looking at before exit, about looking at these group structures. And yeah, the legal protection is really a main thing people like to use.
Yeah.
So having your assets completely separate from your trading element. So from a legal lawsuit, it is a separate company, and that can be really beneficial.
Okay, so the more planning, the better.
Exactly.
There are slight costs involved in terms of the administrative side of maintaining the different companies.
Yeah.
But actually, it's something which does just give you the options, and like you say, does kind of future-proof.
Exactly.
And set you up to exit in the most beneficial terms.
Yeah, and then one final thing is you get group loss relief. So the idea is, say you've got 2 current companies in a group structure, they're both making profit, they're doing really well. You decide you want to start a new third, idea. Say that starts losing money in the first couple of years. Normally, if these were standalone companies, you'd have to carry that loss forward. You wouldn't get relief for it immediately. Yeah. You're effectively paying corporation tax profit on the 2 companies you're making money on, and you're not getting any relief until you make profit on the third one. If you have it in a group structure, you get instant relief for that loss. So effectively, it's improving your cash flow because you're reducing the amount of corporation tax you pay immediately, because that loss gets utilised against the profits you're already making.
Okay, so how do you, if you want to do this, how do you do it?
So you can either do it at the start, so it's effectively setting up a holding company, and that holding company owns your trading company. Yeah. So that's if you're starting completely fresh, you can quite easily do it. If you're looking to set one up when you've already got a trading subsidiary or a trading company or a few trading companies, that can be done, and it's done through a share-for-share exchange. So as long as you meet all the relevant conditions, it can effectively be done tax-free. There's just a lot of legal work that is required to get it done.
Okay. Right, let's see. We've got a couple of questions here. Thank you. So let's just pause for these. So within a group, so Simon, this is your question. Within a group structure, can you move cash profit to another business within the group structure, either through lending or investment, and use this as a way to mitigate corporation tax?
It doesn't mitigate corporation tax specifically. You can move funds from one company to another quite easily, but effectively the idea is you pay the corporation tax profit in the company that it makes money in, and that pays the corporation tax, and then those funds can be transferred over into another company, and that can then utilise it and do things with it, and that would naturally lead to effectively a cost, and that would reduce the future corporation tax profits in the next company, because if you're spending that money for actual business purposes, that's a cost in the company, and it's an expense.
Okay, perfect, thank you. We've got 3 more questions here at the moment. So, for Matthew, do you need to register a group structure with HMRC?
So, not with HMRC, it's effectively on Companies House. So, when you effectively go on Companies House, you can see who owns the shares in a company. Normally it's individuals, so if you were owning your own company, you would be listed as the shareholder. Instead of that, your holding company would be listed as the shareholder on Companies House. That's how it would all work.
So practically, you obviously have to create the group structure, so you need to get all the legal documentation and everything all set up. And then and as part of that process, then that would be lodging it and doing the filings with Companies House to make sure that the ownership was properly reflected there.
Exactly right.
Okay. So I understand that there is a tax free allowance for companies, about 10k. Do you get this on all group companies individually, or is the limit applied to the whole group?
So I'm not sure what that tax-free allowance for companies is specifically.
Okay, so Matthew, would you mind just typing a bit more about exactly what you mean by that one, please? That would be great. Just give us an idea as to where the tax-free allowance is for, or what it's called, or something. That'd be great. Okay. Any implications of the group structure and SEIS or EIS?
Yeah. So it doesn't technically negate SEIS or EIS, but if you are to do under those reliefs, you have to give out the shares in the holding company, which not a lot of people like to do. So in practice, most EIS and SEIS companies are generally standalone, because if you set up a group structure, you'd have to be giving out shares in your holding company, which will also own other companies you own, which you don't want to be giving out shares in. So it can be done, but it's not generally recommended.
Okay, so actually then if you're a company then that is at the stage of SEIS or EIS, is the advice to sort of get through those stages of funding and then
and then look at move it into a group structure later. Yeah, that's probably my recommendation. But everyone is individual, and there can still be benefits of doing it.
Yeah.
So feel free to reach out, and we can give you some recommendations.
Okay, perfect. Right, more questions. So I'm pleased we stopped. I'm pleased we stopped after this part. We have got all these other areas as well, which we'll cover. We may well not cover all of them, but we can just do another follow-up webinar if we don't get through these bits. Keith, thank you for your question. Presumably a group structure is highly desirable for companies that generate and protect novel IP with a view to out-licensing that IP to third parties thereafter as its business model.
Yeah, that makes a lot of sense, and a lot of companies even like to move their sort of IP abroad, and you can be tax efficient with different corporation tax rates in other countries. There's obviously anti-avoidance rules around that, but yeah, that's definitely a big thing we've seen in our clients that like to do that sort of stuff.
Ange, what if I have a registered company which is just registered? I've not yet started trading, but want to create a holding company. How would I do it?
Yeah, so effectively, if you've got a company already set up, that could quite easily become your holding company. So when you set up effectively a new company, or when you register with Companies House, you would list the existing company as the 100% shareholder, and that would effectively create a group structure because you own the current company you own 100%, so you're the sole owner, and that company would then 100% own the trading subsidiary of the new company you form. So it's very easy to do. You just change the codes on Companies House to make it a holding company of the existing one, and then when you incorporate the new company, you just incorporate it as with not you as the shareholder, as your existing company as the shareholder.
So you get, a lawyer could help do the company incorporation and help you with any of the coding or
exactly.
Like that.
So we can definitely do that sort of stuff for you here.
Okay, Matthew, on tax-free allowance, I may be mistaken. Well, it will come. There's lots of tax-free. There's lots of tax allowance things that we're going to cover through the rest of the questions as well. So let's see, Matthew, if we answer that through one of the other areas, and if not, then just give us a call and we can have a chat and see if we can get to the bottom of the thing that has nudged your question in the first place. Okay, so I think that is all sorry, I'm just keeping track. There's questions on the Q&A and there's questions on the chat. So I'm just double checking both to make sure we've answered them all so far. Yes, I think we have so far. So, okay, next topic, expenses, business expenses.
Yeah.
What are the rules?
Yeah.
Please.
Yeah. So HMRC's general rule on business expenses is wholly, exclusively and necessary for the trade of your business. So a lot of this stuff is very simple, like if you're a shop, all your stock is effectively just an expense. That's all seen as very normal. Everyone sort of knows that sort of stuff. Anything you need to do your business, that's basically an expense, and it reduces your final corporation tax liability.
Yeah.
So that's normal stuff. Everyone's going to think of that sort of stuff. There's certain things that people don't always think about that is considered a business expense, and that's just the usual stuff. So, when a lot of entrepreneurs, they have to buy laptops, they have to buy mobile phones, those are all considered business expenses. So even though you technically get some personal use out of it, HMRC generally see all IT equipment, printers, laptops, computers, mobile phone monthly contract expenses, that's all, you get one mobile phone for free, there's no benefit for that. So that's all a business expense, which is making sure you are claiming all that sort of stuff through your company. Travel and subsistence, that's a big, obviously whenever you go, you meet your client. So travel to and from your daily office, that doesn't count as a business expense. But when you're going to meet a client, and you're going to have lunch with them, that sort of stuff, that's all part of your business trade, and you get to expense all that sort of stuff. And then training courses, so if anybody has to do sort of training as part of their work, CPD work, they go to web conferences, that sort of stuff, the cost of that, that's all a business expense. Those are seen as sort of normal stuff, and people generally know about those, but they can forget sometimes. But there's a difference between those and what's seen as tax efficient expenses. So in general, these expenses are things where you don't really get any individual benefit from. So it's mainly wholly and exclusively for the trade and business. So the idea is the individual doesn't, or the director doesn't really get any benefit from it. Tax efficient expenses are, so if you do have an expense, so say you end up paying say the business pays for your holiday, that's seen as an expense for the business, but it's a benefit for you, and therefore you have to pay tax on that benefit.
Yeah.
So there's no reason to do it that way. You just pay for it yourself.
Yeah.
Tax efficient expenses are sort of seen as expenses which reduce your corporation tax liability, that lead to a personal benefit, but that doesn't have a benefit charge to you.
Okay.
So effectively, you're not having to pay income tax on the benefit you're receiving, even though it's not necessary for the business's trade.
Okay.
So one of the main ones, which everyone generally knows about, is pensions.
Yeah.
So effectively, any money you put into a pension fund for the director, for your employees, that's technically a benefit for the individual, but there's no benefit charge for them, and it reduces your corporation tax profits. So it's a very efficient way of basically reducing your corporation tax profits and taking money out of your business. On top of that, life insurance policies, they're not a P11D benefit for directors or individuals. So if you set up a life insurance policy for yourself as a company director, that would reduce your corporation tax profits, and it wouldn't lead to a benefit in kind charge for you either. Other things like counselling services, so that's also now considered a non-P11D benefit charge. And then trivial benefits is another one. So it's basically like a £50 small benefit you give to someone you take them out for lunch, or so you get taken out for lunch, or a bottle of wine for your birthday, that sort of stuff. If it's below £50, that's no longer a benefit in kind either. The only difference is that's unlimited for employees, but for directors it's capped at £300. And then the final one is electric cars are always seen as very tax efficient. That does have a benefit in kind charge, but it's a lot smaller than petrol cars. So currently I think the rule is either 2 or 3% of the list price is a benefit in kind, but it is going up every year by 1%, so just bear that in mind. But in general, it's very tax efficient to have electric cars for your company than individually.
And is there a time frame for how much longer the 1% increase is going to last? So
it's going to be happening every year up until 2030, I think, until it gets to 8%.
Okay, and then that is going to cap at 8%.
Well, the current rules it says cap at 8%, yeah.
Right, tax efficient expenses. So let's pause and let's see if anybody's got any questions about any of that side of things. Bicycles.
Yeah, cycle to work schemes are part of the benefit in kind. You don't have a benefit in kind charge for cycle to work schemes yet, so that does work too, bicycles.
Okay. And scooters?
I don't know about scooters. I'm pretty sure it's only bicycles, but I'm not 100% sure on that. I think it's only bicycles personally. Cycle to work scheme is what it's called. Yeah. So I assume it's only bicycles.
Yeah. Okay, so that's all the questions on that one. So actually that leads quite nicely on to the next one. So the pensions, obviously the rules have changed recently. Well, the taxes have changed recently rather than the employers' national insurance one, which has linked implication to pensions. So what should people do when they're you've mentioned a little bit about how the fact is you put money into your pension, the reasons for doing that, but can you tell us a bit about what the limits are and how people can maximise them, please?
Yeah, of course. So to start with, obviously pensions are just generally super tax efficient, right? When you're taking salary out of your company, when you're taking dividends out of your company, you're paying income tax 20, 40, 45% on this. With pension contributions, you're paying zero income. As long as you're within the limits, you're paying zero income tax on this. So it's such a good way to take money out of your company and put it into a pension fund. The current limits are £60,000. So there is tapering allowance, so it does technically depend on how much money you earn. But I believe if you earn less than £200,000, you're not really impacted by this. Once you're starting above that amount, then your annual allowance does drop. But in general, so you currently get £60,000 of annual allowance pension funds. So effectively, you can put £60,000 every tax year into your pension fund, and there's no tax implications for you for doing this, and you save corporation tax. So it's super, super beneficial. There is carry forward available to individuals. So, for example, say you decided say you made loads of profits in this current tax year for your company, and you realise you haven't made pension contributions in previous years, you can technically use your previous unused annual allowances and carry them forward. So if you go above the £60,000, technically speaking, you could maybe pay £200,000 in one tax year, and you still wouldn't be subject to any charges because you have previous carry forward available to you.
And so how how historic can the carry forward
So
be?
you can basically go back 3 tax years.
3 tax years.
So effectively, you can have 4 tax years worth of allowances in 1 tax year.
Hmm.
So there is definitely, if for some reason, like, say you've done really well in this most recent tax year, and you want to start reducing corporation tax liability, it's a very good idea to look at your pension, look at your carry forward, and see, can you make use of it. There are certain rules you have to have met, so you have to be registered a pension fund. So, but that doesn't have to be the existing one. So if you worked somewhere else in the previous years and didn't really utilise it, you can technically, that counts as you being registered for a pension fund. And then with this sort of annual allowance, bear in mind it's not just into each pension fund you're in, it's all your pension contributions in total. So if some people are employed and they have their own company, they might already be on an auto enrollment scheme at work.
Yeah.
So bear that in mind, and that all those contributions you've already made there throughout the year will impact your annual allowance.
Okay, so 60 annual allowance all in.
Yeah,
Doesn't matter where you put
yeah,
it.
exactly, yeah.
Okay. And what about when the money then is inside the pension fund? Then what happens?
Yeah, so a lot of people think pension funds can only really invest in stocks and shares. So certain people have avoided using pension funds for that reason. They don't really like the stock market, and it's a bit too volatile for their liking. That used to be the case, but nowadays there's almost total flexibility in what your pension fund can invest in. And a big thing for business owners, as I've seen, is investing in commercial property.
Yeah.
So a lot of business owners will have a warehouse, will have an office, will have things that they utilise for work. There is no reason that your pension fund cannot go and buy that warehouse for you, and effectively those funds that you have in the pension fund, they go and buy a warehouse, they go buy an office, and your current company leases that office from your pension fund. And what that means is the lease cost that you're paying to the pension fund is a corporation tax deduction.
Yeah.
And then, but because everything in the pension fund is considered tax-free, the rent that it generates is not taxable. And also, if it sells it, there's no capital gains tax to pay either. So you can basically utilise your pension fund very well with your current business, and it's all linked together. In addition, you don't have to have your own pension fund to buy this sort of stuff. There's a thing called a SAS, and effectively what it means is, like, say you've got 4 directors in a company, all 4 of you can combine your pension fund together. You can go buy a commercial property together and lease it to your existing business. There's no reason you have to do it individually.
Is that definitely legal?
It's very much legal. It's all very much allowed, and you guys you will own the percentage of the pension fund that you contributed to. So if someone's contributed 100k, someone's contributed 200k, you get 66% versus 33%. And all growth in the pension fund is all tax-free. So any money it generates through like rent or stocks and shares growth or capital sales, all tax-free.
Gosh. Okay. Any questions on that side of things? On any pensions related ones? Okay, so we've got a question. So this isn't specifically about the pension ones, but let's do it now. So I'm a new limited business, no profit yet, but there are this is on the expenses. Okay, perfect. But there are expenses. Can you walk me through step by step what needs to be done in terms of taxation?
Yeah, so you don't have to like make profit to have expenses in your company. Obviously, a lot of companies make losses in the first few years, so that's quite normal. If you just have one business, the idea is any expenses you make, you basically claim them as part of your company accounts. So whenever you do your corporation tax return, whenever you do your company accounts, you report all your expenses, you have a loss at the end of it, and then you will not pay any tax at that point, and you basically carry forward that loss until you start making profit. That's how it will generally work.
Yeah, so you keep track of it. I mean, yeah.
You basically keep track of it, yeah, it's part of your company accounts, it's part of your annual filing, and you just carry a loss forward until you start making profit.
Okay, I hope that answers your question. So the next bit then, we've got 2 more sections here. So the next one is all about profit extraction. Can you tell us, Andrew, what are the main ways for extracting profit from a business, and how do they compare?
Yeah, so the main way people take money out of their business is through either salary or through dividends.
Yeah.
And you will hear a lot of people talk about like take a £12,500 salary and take the rest out in dividends.
Yeah.
And people say it, but not everyone understands why you do it that way.
Yeah.
So what I can show you is that the main difference between a salary and dividends is a salary is a corporation tax deduction, while a dividend isn't. So dividends are taken out after you pay corporation tax. But when you pay yourself a salary, say you're a company director and you pay yourself like £1,000 a month salary, that £1,000 a month is a deduction when you look to pay your corporation tax. That's a cost for the company.
Yeah.
So that's why we do that sort of £12,000 salary. But then you might think, why are we not doing a higher salary? And the main reason for that is actually NIC rather than tax.
Yeah.
So while you earn
So NIC being
national insurance.
Yeah.
So while you earn £12,500, there is no employee national insurance due, which basically is currently at 8%, I believe. So anything above £12,570, you also pay 8% in national insurance. So instead of just paying 20% tax on it, you're also paying another 8%, and that kind of neutralises the benefit of having a salary as a corporation tax deduction. Yeah. In addition to employee NIC, there's also employer NIC, which is now at 15%. That technically only comes in at £5,000. So anything above, you earn above £5,000 of salary, you pay employer national insurance, and that's at 15%. So once you add in 15% plus 8%, plus the tax at 20%, you neutralise the corporation tax deduction that you were previously getting. So that's why it's sort of done up to a limit, where you have these allowances, and then anything above that you generally take as dividends. The main thing, the other benefit of dividends is they also tax at a lower rate. So while you're a basic rate taxpayer, so any below £50,000, salary is taxed at 20%, whereby dividends is taxed at 8.75%. So that is quite a major difference, and it makes it becomes very tax efficient. So you've probably all heard of take £12,500 salary, take £37,000 as dividends. You basically pay like £3,000 in income tax. So it can be very tax efficient. Your margin, your average tax rate for that income is very, very small. You're looking at like 4%, 6%. So it's very efficient. So those are sort of how it works. I mentioned employers' national insurance. So if you're a sole director of a company and you are the only one, sort of, you're the only one taking money out of the company, you're the only one taking salary, then you don't get the employer's national insurance allowance. However, once you have two directors or you have an employee and a director, you actually get the national insurance allowance, which basically means the first £20,000 of employer's national insurance is not due. So that's why you can sort of have these £12,000 salaries and not pay national insurance, employer or employee, as long as there's two of you working for the company.
Okay. Your chair is very squeaky.
Yeah, it is, yeah.
Do you want to swap it with the one beside you?
Sure.
Sorry, we're just doing a bit of furniture moving here. It's got a very, very squeaky old chair. So that explains why you would do dividends and why you would do the salary.
Yeah.
What are the things that could go wrong? Are there any kind of pitfalls to be wary of?
Yeah, there are, yeah. So specifically with dividends, not everyone knows this, but dividends can only be taken out when a company is making profit. While a company is making losses, technically it's illegal for a company to take out, it's illegal for an individual to take out a dividend from the company. So you can't do that, so bear that in mind. So yes, it's more tax efficient, but if it can't be done, it can't be done. Yeah. So if you're a new company and you don't believe you're going to be making profits in the first few years, make sure you take all the money out as a salary and pay PAY on it, because that's the only way you can actually do it. One of the other tax traps that people often think about is the 60% tax trap, or once you start earning above £100,000, you start losing your personal allowance. So really, the key message really here is try and keep your sort of individual income below £100,000, because once you get above that amount, you are generally paying tax at 60%, between £100,000 and £125,000. So that's just something to bear in mind. And then finally, directors' loans are quite a common thing that happens within companies. So a director's loan is effectively, if you put money into a company, you can effectively take that money out tax-free at any point you want, but these technically director loan accounts can be overdrawn. So effectively, you've taken more money out than you've put in, and then effectively you owe the company money. And obviously, people can do that very easily, and it could be quite exploitative. So what HMRC have said, that is, if you owe the company money 9 months after the end of your corporation tax filing deadline, you actually have to, the company itself has to pay tax on your behalf on that sort of income that you have taken out, effectively tax-free. So there's like a section 455 charge, which is effectively 33.75% on that amount that you have overdue, and you have to pay that 9 months after. So if the loan hasn't been repaid, you have to pay that to HMRC, the company has to pay that. Technically speaking, it's not a tax payment, because once that money is repaid to the company, you can reclaim that 33% tax charge. But it is going to be a significant cost for the company. So bear that in mind. And technically speaking, once you have a loan from your company above £10,000, that's also a benefit in kind charge. So also keep that in mind too.
And what about when you're thinking about, when you're planning, how you structure the business, but you're also then thinking about your wider life, and we talked about this at one of the experiences, and what you do with a lot of our clients is you marry together the life and the business.
Yeah.
So how does that work? So if you're thinking about retirement or buying a property or something.
Yeah, and I think a lot of people take money out of their business just to put it into savings accounts.
Yeah.
And that really isn't that necessary, because at the end of the day, that money can move from your business account to your personal account at any point. You don't have to be taking them out like monthly just to start putting it into your savings account. That money can technically be invested while it's inside a corporate company, and you can start generating interest on that money while it's inside there. You don't actually have to start saving it individually.
Okay.
So it's generally better to keep it inside a company. There's no point paying income tax on money you're just going to save. You may as well leave it in the company and take it out when you need it. In addition, people take out money to go buy investment properties. There's really no need to be doing that. You could quite easily be setting up a group structure like we spoke about earlier. So you have your trading company on one side, and then you have your property investment company on the other. Effectively, those funds can transfer one from one company to the other, and that property company can then go invest in investment properties, start basically buying them up, and that can be part of your retirement planning. And you're not taking this money out of your company; you're basically leaving it in there, and you're not paying income tax on it.
So there is just a lot. There's a lot to think about.
Yeah.
Okay, so anything else on profit extraction before we see if anybody's got any questions on that?
No, I think it's sort of being efficient with what you're taking out of the company. So, you have these sort of rate bands and lower rate bands. So, there's no one fixed rule for everybody. But I would say in general, it's quite tax efficient to take money up to £50,000. Between £50,000 to £100,000, it can still be worthwhile, but do it when you need it rather than just do it for the sake of it.
Yeah.
And then really try and avoid going above £100,000. But if you do, you want to be going like £150,000 to £200,000 to make it worthwhile.
Yeah.
So once you go from £100,000 to £125,000, you're paying 60% tax. But once you go above £125,000, you're paying 45% tax.
Yeah.
So it technically drops. So it feels more. If you're only taking out £120,000, it feels not that worth it. If you go to 150, it feels like it's okay. It doesn't. There's no rule about it, but it feels like it's worthwhile there.
Funny old tax bands.
Yes.
Very curious. Okay, anybody got any questions on that, please? On anything to do with profit extraction? Or if not, we will just pass on to our next. Here we go. So, Ali, this is your question. Does reinvestment have any tax benefits?
So it kind of can. So obviously, if you reinvest the money into a sort of property, like a buy-to-let property, you don't really get relief for that cost immediately. You only get relief for that cost when you sell that investment property. So in that sense, you don't really get the benefit. What you do get is, if you speak to IFAs, like independent financial advisors, what they can do is they can actually invest your money into certain stocks and shares where if you receive interest and dividends, that isn't actually taxable. So that can be quite a beneficial way to do things. And the reinvestment, like for a tax benefit for reinvestment, only really works if you're doing actual business expenses. So say you set up two different businesses and they're both trading businesses. Say you have actual business expenses, those are costs, and that gives you a tax benefit. But buying a property, not immediately, no.
Okay, any more questions? Let's see if we've got one more. Okay, so I am from the USA, and I'm wondering, as an LLC, how often you should be filing your taxes?
So you have to file taxes annually. So corporation tax is basically accounts are due like once a year, and then individual tax returns are also due once a year. Corporation tax basically depends on when you set the company up, and it's sort of 9 months after the end of the accounting period. And then individual income tax returns are due 31st of January after the tax year is completed.
It is a lot. It's an excellent comment. It is a lot to take in. It is a lot. It is definitely a lot to take in. There's a couple more questions here which we'll cover off. Somebody's mentioned that you can invest pension into SEIS or EIS registered businesses. Is that true? And if so, how does that work?
I don't think that is true, and I don't believe you would get any benefit, even if it was true. You wouldn't really get any benefit from doing that. With EIS and SEIS, you really want to be investing with your individual money because of the income tax reliefs you get with it.
Yeah. Can you just remind us what the income tax reliefs are?
Yeah, so if you invest in EIS companies, you get a 30% tax credit, and with SEIS, you get 50% tax credit, which basically means if you invest £100,000, the HMRC will give you £50,000 back as straight cash effectively, as long as you pay that much tax on other income. So in reality, even though you're only investing £100,000, you're only risking £50,000. Technically, you're not even risking that much. You're actually risking less because you get loss relief, and so if the company fails, you get more income tax relief. You also get benefits. If it does make money, you don't pay any capital gains tax as long as you hold it for long enough. But so in reality, you don't really want to be investing in SEIS or EIS companies through a limited company or through a pension, even if that is possible. You really want to be doing it through your individual name.
Okay, perfect, thank you. Can you advise on how to manage employers' NI? So that's one of the things we were going to cover actually.
Yeah, so we can talk about it now. So obviously employers' NI has just gone up. So it used to be 13.8%, now it's 15%. As long as you have actual employees, you'll all be claiming the NIC allowance, so that's fine, that's very easy to do. But salary sacrifice is probably the main way you can start looking to avoid, well not avoid, but reduce your employer's national insurance contributions. So what salary sacrifice is effectively the employee decides to give up part of their money in exchange for something else. In most situations, this doesn't save you national insurance, it's basically seen as you're trying to avoid it. But in certain situations, you can actually make benefit of this. One of the main ones is pensions. So most people do like the nest pension with employment. So effectively, the individual puts in 4%, the government gives you 1%, and then the employer will give you 3%, and the 4% the individual is putting in, that's actually them receiving actual money and then putting that straight into a pension. So you, as an employer, would have to pay employers' national insurance on the 4% they put in, because they're receiving that money and they're putting it somewhere else. Alternatively, you could agree with your employees that they effectively salary sacrifice, so they give up the entitlement to that money, that 4% or 5%, whatever it is, and instead you, as an employer, put in 8% into the pension fund directly. So effectively, you're making pension contributions on their behalf of 8% rather than 3%, and they're giving up their entitlement to the additional amount of money, and that would save employers' national insurance on the money that they're giving up. So obviously, depending on how many employees you have, that could be quite a beneficial thing to do.
Does it mean that the employee receives less in their pay?
No, so the employee's net pay would remain exactly the same, and the cost to the employer would remain exactly the same. The amount of money going into the pension fund would remain exactly the same. The cost to the employer technically goes down because you're not paying employers' national insurance, and technically taking the employee benefits too, because they're no longer paying employees' national insurance and the money they're giving up to. So both people benefit. Okay,
so salary sacrifice is the answer to that one. We've got another couple of questions here. So I have got 3 companies that I currently run separately. I own 100% shares in one of the companies, but a fraction of shares in the other 2. How can I manage these in a tax efficient way? And that's the group structure.
Yeah, that's the group structure. So generally, it's quite difficult to move like fractional shares into a group structure, mainly because there can be that sort of tax charges with it. When you own 100% of the company, it's considered tax-free moving them in there. When you have a fraction, there's a cost to it, and there may not be the overall benefit of selling it, which when we get onto the section later. Company sales, when you only own a fraction, it's not always that tax efficient to hold it inside a limited company. So in your situation, it may not actually be worthwhile. We probably need to do some more investigation to see, do you even want to do that, or will it be beneficial?
Okay, so shall we just go on to that? So I know there's another couple of questions, but I'm slightly conscious of time. Let's just go on to that one, and then we'll come back to the last 2 questions if we can.
Yeah, sure.
So the last bit is all about exit planning. So this is all about the difference. What is the difference between selling a company that is within a group structure or a standalone?
Yeah, so this is where the big difference between group companies really comes in. So if you sell a company while it's in a group structure, technically speaking, you're not actually selling the company, right? Technically, the holding company that you own is selling the company because that's the one who owns the shares. And what that basically means is the funds that you generate from that company sale, you don't technically own them, right? But technically, the holding company owns them. So then you have to think about how do you extract that money tax efficiently, which you're currently doing, through salary, through dividends, through a member's voluntary liquidation. So in that sense, that's why it's very different. So what would normally happen is if you sold a company to a group structure, the holding company that sold it would pay corporation tax profits on the amount of money it made. However, there is actually relief available, and it's called substantial shareholders exemption. And there's a number of different conditions which we'll go into later. But if you're eligible for it, you don't actually pay any tax at the point of sale. So if you're eligible for this relief, when you sell a subsidiary inside the holding company, there's no tax charge at the point of sale, and that money just remains in the company, and then you decide how you take it out tax efficiently. So that's through salary, that's through dividends, that's through, some people like to basically go abroad and take money out that way, and there can be lots of tax efficiencies in that situation. And then if you sell a company when you own it directly, that's when effectively you own all the shares in the company and you sell them, you pay capital gains tax in the year of sale. That's automatic because there is no way of avoiding it. However, there can still be additional reliefs you can claim. So a lot of people have heard of entrepreneur's relief. It's now called business asset disposal relief. So most individuals who sell capital assets like shares will be paying capital gains tax at 24%. But if you're eligible for business asset disposal relief, you'll be paying in the current tax year, 25-26, it's 14%. But the next tax year and going forward, it'll be 18%. So instead of paying tax at 24%, you'll be paying at 18%. But that's only on the first £1 million you make. And that's actually a lifetime limit, not a company limit. So if you've already claimed this in the past, either entrepreneur's relief or business asset disposal relief, you only get a lifetime limit of £1 million. If you sell further companies, you won't be able to claim the relief.
Okay, so in terms of planning then for the exit, what should people do? So we've talked about, I mean, obviously the group structure, you've talked about that for like 5-6 years in advance. Is there anything else that people should do?
Yeah, of course. So we spoke about two different reliefs here. We talked about BADA, business asset relief. So we'll focus on that one now. So there's certain conditions that have to be met to be able to claim that relief. So one of them thing is you have to have owned that trading company for the 2 years prior to the sale. You have to have either been an employee or an office holder, so it's a company secretarial director, and you have to have owned 5% of the shares with voting rights and be entitled to 5% of the profits. So as long as you meet all these conditions, and it's a 2-year ownership period. So it's really making sure you meet all the conditions for the 2 years prior to sale. So that's kind of where the planning comes in. And those are the sort of things you need to be looking at for if you own the company directly. If you own it through a group structure, substantial shareholders exemption is very, very important, I'd say. It makes having group structures one of the main reasons for it. So part of the conditions is you have to have owned that trading subsidiary for 12 months within the group structure. You have to have owned at least 10% of the share capital, and you have to be entitled to at least 10% of the profits. So if you don't meet those conditions, you would be paying corporation tax on the profits of selling the company. So you'd be paying 25% corporation tax on the sale, and then you'd have to extract it either through a liquidation or through salary and dividends. You pay more tax, so it becomes inefficient almost having a group structure. So making sure before sale you kind of meet all these conditions, that's to claim the relief. In addition, obviously we mentioned like degrouping charges earlier. So that basically means that if you had transferred assets from one company to another in your group structure, you want to do that 6 years before sale for capital gains tax purposes, and you want to do it within 3 years for stamp duty purposes.
Okay, so we will follow this with a transcript of what we've talked about, because there are just so many different points, and I think we're trying to cover as much of this as possible, which does mean that we are covering a lot of different things.
And then, sorry, the one final thing is these reliefs are only available for trading companies. So not everyone knows this, but there's two different types of companies in the UK. One's called an investment company, one's called a trading company. Investment companies are sort of stocks, shares companies, property companies, where the majority of their value comes from holding an asset or having an investment. But trading companies are ones who actually go out and make money and do trade and is an actual business. And to get both substantial shareholders exemption and BADA, you have to be a trading company. And HMRC don't technically have a rule on technically a company can have trade and have an investment at the same time, and there's no specific rule on how much money, like what is a trading company in that sense, because it's technically a mix. But HMRC say substantial is kind of their rule, so they say like 20%, like as long as less than 20% of like sort of the profits or the income or the amount you're spending is an investment side, then it's a trading company. Once you go above that 20%, they can argue that you don't get the relief.
Okay, so lots of things to be aware of. I think just before we go back to the final questions, just again conscious of time, can you just get, obviously we had the autumn budget was a while ago, there'll be another one in the autumn. We've covered quite a lot, I think, about what, I mean, certainly the employers' NIC stuff, which is a big implication of that. So in terms of one thing, if there's one thing that you'd like people on the call to remember, what is it?
I'd say very much look at your remuneration. Like, how do you take money out of your company, and are you being tax efficient with it? A lot of people just take it out sort of as and when they see fit, or they're not really planning for the future. They think they don't really need that money right now, so they're not going to take it out. But in reality, if you're not utilising your lower tax rate bands, you'll be paying way more tax in the future. So it can be more efficient to take a little bit out now and leave some of it in there. And just making sure you're taking it tax efficiently. You're taking out a salary, you're taking out dividends if you're making profit. You're putting money into a pension, which is going to save you loads of amount of tax. So basically looking at that, and is it being done correctly? Some people take a £76,000 salary and a £30,000 dividend. It really doesn't make a lot of sense to do it that way. You want to do it the other way around, especially when you're making profit. Okay,
perfect. Thank you. So we've got a couple more questions, and I think we'll have time for. So going back to Matthew, going back to the company, the holding company structure. Presumably the subsidiaries do not need to be 100% owned by the holding company.
No, so you can have different types of groups. So you can have just a general group where there's no fixed percentage limit, or you can have a 75% group, and the 75% group is where you have to have at least 75% holding, not 100% but 75%, and with a 75% group, that's when you get the group loss relief benefit, that's when you get the ability to move assets around. So that's where percentages will have an impact. It doesn't have to be 100%, but if you can aim for 75%, you'll have a major benefit overall.
Okay, and last question is, I have a regular salary job and a company on the side. If I don't take any salary or drawings out of my company because I don't want to have the additional income alongside my salary, can the salary that I would have taken from the company accrue as a director's loan account so I could take it out tax efficiently in the future?
No, unfortunately not. So unless you effectively pay so you technically kind of, but you would have to pay tax and income tax on that salary you're taking out that you haven't taken out. So it really wouldn't really benefit you in any real way. So you can't say, I would have taken the salary, I'm not paying tax on it, and it's a director's loan. That really doesn't work. You could technically put it through payroll, pay the tax on it, and not take it out, and then it could add to your director's loan, yes, but you would have to be paying tax on something you're not actually receiving.
Okay, I think that is it. Thank you very much. I hope we haven't completely baffled and perplexed everybody. We have covered a huge amount of topics. Thank you very much, Sanjay, for talking through all those different things. We will share after this, we'll share the transcript, we'll share the recording, we'll share some sort of key takeaways and key points, and we'll also share Sanjay's details. So if there are, I mean, as with any of these things, you know, the answers are so personal to everybody individually. So there'll be a link to book a call with Sanjay. We call them discovery calls, so there'll be a link to go through to the website. You choose a time and thing that suits. So please feel free to get in touch if we haven't answered your question, or if there's anything sort of wider that you'd like to talk to. As is very evident, Sanjay knows an awful lot about tax. We will be doing, ahead of the autumn budget, we obviously don't know the date of that yet, but we will be doing a webinar shortly after that to talk through whatever changes may come through that. So we'll share the details of that with you in due course, and please feel free to join us. But yeah, that is it. Happy rest of Tuesdays all, and thank you very much for joining.
Thank you very
Bye-bye.
much.